Welcome to a special edition of our FSC monthly vlog themed Election Fever with your host, Development Director Ron William. We'll be looking at the update of what's happened since the results of the Trump win, looking at the global ranking model and the legacy fear rotation in past volatility and ongoing inflation expectations, what that means for markets, specifically equities, and an update on the triple whammy headwind of momentum, rotation fragility, and bearish cycle confluence. Now, to begin, a picture speaks 1,000 words, cartoons even more. We can see here the choice on the left as pictured by various media across the stream. But the segue theme that I'd like to play on is that classic fever song. Everybody's got the election fever. That is something that you all know. Fever isn't just a new thing. Fever started a long time ago. So, of course, this is from the rock and roll star Elvis Presley, spotlighting heightened market sentiment into the US election season, now past, but of course, inauguration still ahead. This event risk proved close in time, still uncertain in outcome, high stakes for future policy, and ultimately market impact. Now, the markets proved out correct. History will now confirm. Certainly when we look at interest rates, but also equities, US dollar, and Bitcoin, predicted the upsurge, but also a potential Trump win. Now that's looking at a match of interest rates in orange, in blue, overlaid the betting odds for the Trump win in orange. Now there was a little bit of an unwind going into the elections in terms of the potential outcome, but ultimately in the final few weeks, we did see a shift to the upside. Now, why is that? Why were markets signaling a potential Trump win? And ultimately, what was the perceived policy impact of such result? So essentially, if we look at rates, equities, dollar, and Bitcoin up, rates specifically, and that potential inflation story is the expectation of a Trump win leading to massive fiscal stimulus in the form of tax cuts, deregulation, and tariffs. Now, looking at the dollar, of course, that would have been a dollar-friendly environment given potential growth increase, but also the shift away from de-dollarization in terms of tariffs across countries that were potentially going to do so. Equities, a revived animal spirit in the perception of what Trump policy could do, again, to the economy and to the markets. And Bitcoin, a little bit more of a friendly regulatory environment for the market. Now, one thing that wasn't factored in was the red wave surprise. That's something that the market is still pricing in. However, we should be careful not to expect that these markets that predicted the Trump win and the potential policy impact to continue in a straight line trajectory. However, key market proxies have a more unique sentiment drive and cyclical path ahead. And this is what will be most useful to focus on in this special edition session. Now, if we take a step back and look at the bond market volatility, most people look at volatility in equity markets, looking at the VIX, but the equivalent of that in the bond market, the MOVE index, did signal, the sentiment perception for elevated volatility going into elections. Now, since then, literally in the last few days, we've seen a collapse in that volatility proxy. after the protest outcome was confirmed. And in addition to that, the Fed policy just passed the 25 basis point cut already now making headline news. Now, the previous rise to the one-year high signaled a fear resurgence ahead of both event risks, election as well as Fed policy. Here and now, what next? Important to keep in mind that there's no correlation between yields and this bond market volatility, unlike equity markets and the VIX. However, that also means that lower volatility is likely not to pressure yields lower. And this is what we're seeing now, a little bit of a divergence of what was matching before, both heading up in the same direction, up. And yet now yields holding firmer. Now we see this in a global ranking model, systematic approach of best and worst trends in terms of what's happened post-elections. More of the similar themes pre-elections now prevailing forward. Essentially, it's that legacy fear rotation of perceived volatility, which is now unwound, alongside a resurgence in inflation. The three key markets are gold, China, and rates. And just as a quick educational framing of this chart, essentially we're looking at trend performance over time from right to left, long-term, medium-term, short-term, and from top down, the strongest versus the weakest. And you can see there in green, China, top, gold, top, but unwinding in the medium to short term, USA in absolute terms, new all-time high, which we'll speak to in more detail, but the relative performance compared to global cross assets is unwinding. So the rate of change compared to other assets is lower than we might think. So keep in mind, gold overbought, likely unwind before the next move up to 3K. China upside reversal post-stimulus. The big theme there is that with the Trump election result, China will likely pump more stimulus into the market to ultimately counterbalance any ongoing US-China tensions and potential tariffs. And then US rates, as I just highlighted on the top, is part of that inflation resurgence story, partly because inflation's in the system already based on recent expectations, CPI data, but also policy impact from a Trump presidency. Now let's focus on US equities, which is the main proxy that FSC members and many professionals around the world trade, or at the very least use as a risk proxy for next moves on markets. Now the key theme there is the triple whammy headwind, which I've alluded to for most of this year and remains still ahead into the new year. Those three factors are momentum, unwind, rotation, fragility, and timing confluence. Looking at momentum, essentially, it's an update now on the pattern, the momentum exhaustion, and that long-term structural bull trap signal that is work in progress as we speak. Now, the short-term updated pattern continues to display an impulsive trend reversal as part of the Elliott wave pattern. For those of you that want to learn more, do look at the work of Elliott Wave International and Mr. Robert Prechter in reports and books that have been published on the subject, including the latest pattern count. What it shows here is that we are likely in a wave 5 of higher degree, which is now part of this trend channel with resistance ahead, just under the 6,000 psychological level. And I'm just going to quickly highlight this on the chart, just so you can see the line of eyesight. Now that chimed in with a short-term cycle according to proprietary timing models that I use in addition with the FSC model and other timing overlays, and led to the euphoria or the fever of this election event risk. Here and now, there is trend pressure both on price and indicator just down below. Now, to add to that is the mark momentum exhaustion signal, and that is basically a mathematical objective proprietary indicator developed by Mr. Tom DeMark, who's one of the leading timing experts in the industry. He's contributed for the FSC in past events, so you can look for more information on our FSC Cycle TV and in general. This is showing a red 13 signal, which is kind of like a red card warning signal across a range of time chart fractals, monthly, weekly, daily, which increases the probability of a potential exhaustion and reversal imminently over the next few days, weeks, and certainly month ahead. Now, the risk zone, which is produced on this indicator, i.e. risk zone that neutralizes the bearish implications if we continue to trade above, is between 59.02 and 58.31 on the S&P 500. If we break back under that area and confirm into 5,700, then we're likely to target further downside levels. The long-term levels are at 5,400 and 5,130, but we're some way away from that here and now. We're at all-time highs. Keep in mind that this key downside trigger does coincide with a larger bull trap signal, and that is the ongoing historical analog that we should keep in mind in terms of the structural top that will likely follow through. This continues to be the roadmap analog, which is basically a bull trap pattern scenario akin to 2007 and 8. And the key disclaimer I want to share here is history will likely have a rhyme variation, but not an exact one-for-one repetition. It's the rhyme, not the repetition. And this is a repetition, a rhyme, I should say, of the three-stage corrective pattern: fall, rally, rest of fall. And the key point here is that when we get the mid-stage rally, it is an all-time high rally now as it was then, post Fed policy, which we've had twice now, and an election, true then as now, which then becomes part of a prolonged topping distribution pattern that unravels not overnight, but over time into the new year. So back then it was 2007, 2008. Here and now it's 2024 going into 2025. Now, part of that pattern unraveling is going to be driven by what's underneath the surface, and that is basically the sectors and the stocks driving both the stock market and the business cycle itself. Now, this segment I'm going to do a brief review of, but essentially it's similar to past insights I've shared, except for the fact that we've seen a blast to the upside in small cap Russell 2000, and certainly the past non-divergence of NASDAQ and Russell 2000 has now been neutralized. All markets, equity market proxies are shooting up high. So just to recap, what is the concern from some time ago and still now is the ongoing record concentration risk that ultimately unwound in the first half of this year, particularly when we went into the Q3 August flash crash. Now, having said all of that, since then we have the tech bifurcation with a broader rotation. Here and now, many of those tech stocks are still looking strong. The key point now being look for potential high beta volatility, both up and to the downside, if and when things change. Now, the point that I want to highlight here, which has changed, is that NVIDIA continues to be at all-time highs as a key proxy for tech and that concentration risk. Continue to watch for a potential exhaustion loss of momentum under the previous all-time high of 135, and then ultimately downside risk into the key zone of 190 to confirm a potential bearish distribution top. Now, what is going to be probably more timely and useful here and now is going to be looking at those faster moving stocks such as Main Street Russell 2000, which has blasted to new highs. So this is an old chart showing some of the volatile and rapid price action that took place as part of what I was terming a pump and dump pattern, which is basically broken to the upside. But we still need to ask the question, how sustainable is this? And if this volatility breakout to the upside may fall to the downside in the near term. Also keep in mind not just the broad rotation that is now taking place, but the nature of the rotation as well. So still we're continuing to see defensive rotation, which is healthy, but better to see a broader style of rotation too for a healthy bull market. And just to close on the timing confluence, an update on the FSE model, little word on year-end seasonality and how that chimes or not now, and then most importantly, the post-election pattern ahead. Looking at the FSE timing model, this continues to suggest risk based on key cycles of the 192 and 89 harmonic. From a timing perspective, it suggests topping now or into year end as part of a year-end rally, going into that long-term peak process of the new year of 2025. Now, if we look at the charts below, you can see the long-term projection on the FSE model on the left, but also how that coincides with sentiment data based on macro external systems such as solar activity, where peaks lead to euphoria and bottoms lead to more fear and bearish sentiment. That external data peaked out in the summer and is looking to unwind lower into the new year. So I've featured that before, and team colleague Lars von Thienen has done too on FSC Cycle TV. So look to both our contributions on that subject. But ultimately what we're seeing here is a confluence, not just across timeframes, but a confluence across different data series, both FSC, short-term, long-term, as well as external macro sentiment data. And just a grand finale chart that I really want to highlight based upon the new republication of our FSC cycle book published by Edward Dewey. Essentially, in the forward there, we have this chart, which is the most documented cycle, 41-month cycle in US stock indices, researched by Edward Dewey between 1868 and 1957, using the cycle detection methods developed by Dewey and others at the FSC. A similar analysis from the early 1950s to today reveals the ongoing cycle of 41 months, though there is a deviation of some weeks, has it persisted until here and now. Why does this matter for all of you now, and why do I share it now? Is because this also confirms a peak in 2025. And if you look at the lower chart, you can see there the peak in 2007 going into 08, and then ultimately the peak here and now going into 2025, and then an unraveling afterwards. So there's a historical beat based on the 41-month master cycle that is popularized both at the FSC and by our founder Dewey, published in the forward of the new book. And this very cycle, as updated by the FSC team, continues to signal a peak going into next year. You can actually test this cycle on the FSC model and get a real-time signal, which is already predicting an imminent downside risk going into the new year. Now, on the election pattern expectations, do know that the election fever unwinds into the inauguration going into the new year. So it's really interesting to kind of think about the pattern of the election cycle itself alongside seasonality going into the year end, all basically confirming each other. But of course, there might be a lead or lag depending on the market setup. So we can see here that the typical volatility amidst uncertainty into the election, the relief rally after the election, and then most importantly, the unwind of election fever into the inauguration. And I think this time will be very different because we also have additional uncertainties in terms of policy impact, particularly with a precarious macro and market backdrop, as well as geopolitical risks that remain. So to wrap, key insights that we covered, looking at election fever, how that will likely play out into new year, the thesis of triple whammy headwinds, equity markets and risk, broadly speaking, and how that ultimately chimes in with the market timing here at the FSC. That's it from your host, Ron William, FSC Development Director, Global Cross-Asset Strategist, and I look forward to future updates as markets continue to move. And of course, look forward to our following week of regular FSC scheduling with team colleagues Lars, Richard, and Jake. All the best, stay in touch, and welcome any questions or feedback on social or email. Thank you very much.